I'm Haley.
And I'm Natalie.
And we're students in the AIM program. And today we'll be pitching QTWO Holdings, Inc., ticker QTWO.
QTWO Holdings, Inc. is a leader in providing cloud-based digital banking solutions and services on their SaaS platform, software as a service, to community and regional financial institutions and fintechs. The company offers custom-built solutions for mobile and digital interfaces regardless of the type of core processing. And they derive their revenues from three segments. Subscriptions account for about 70.4% of their revenue, transactional for about 15.3% of their revenue, and services and other accounts for around 14.3% of their total revenues. The company was founded in 2005 and is headquartered in Austin, Texas.
QTWO Holdings, Inc. went public in 2014 and is initially focused on providing digital banking services. However, since they have expanded their solutions to include banking as a service, BaaS, corporate banking, and digital lending, the company operates in a niche space where traditional banking intersects with fintech. One of QTWO's newest offerings is QTWO Banking as a Software, as a service, which is a set of API tools and gives third parties the option to create bank-like deposit and payments without the need to receive a banking charter. QTWO BaaS powers Acorn's debit card, Credit Karma's apps, and Q Capital's savings apps. The company has seen impressive top-line revenue growth at a 3-year CAGR of 28% and a 5-year CAGR of 32%. QTWO has been able to successfully grow through major acquisitions, expand their solution offerings, and tap into new markets. In October 2019, the company acquired Precision Lender for $510 million, which has been QTWO's largest acquisition to date. The solutions powered by Precision Lender allow for banks to tailor loans to individual customers and to competitively price them. While this only accounts for 5% of their recent revenue, the mobile/digital banking era is still in the early phases of growth. A recent McKinsey study stated that 80% of simple financial servicing transactions and 2/3 of product sales can be done digitally. The study also found that 10 to 25% of customers in Western European markets intend to visit branch locations less frequently, especially after COVID-19, and that only 5% of services need to be done in a branch. Amidst COVID-19, QTWO was able to take advantage of the demand for online lending with the U.S. Paycheck Protection Program, during which time the company provided nearly 150 demo solutions to customers. It is estimated that this will bring in new customers and 10% of revenue for the upcoming fiscal year, and subscriptions are recognized over the life of the contract, with most typical contracts varying anywhere from 24 to 66 months, depending on the size of the customer. Given the company's impressive historical growth, niche market to meet demands, and the digital transformation of banking, it is recommended that QTWO Holdings be added to the AIM Equity Fund with a price target of $120.70, representing a potential upside of over 24.62%. Now moving on to my drivers. The macro trend tailwind. The macro trend of digital transformation is at the forefront of the banking industry. The number of digital users in U.S. banks grew 6% year over year in June to 158.5 million. U.S. Bank estimates that 77% of customers utilize a digital banking service, with 55% using either online or mobile banking. IDC estimates that the economic value is $19 trillion, or 20% of global GDP. Global spending on digital transformation is estimated to grow at a 16.7% CAGR to nearly $1.97 trillion by 2022, and by 2023 be $2.3 trillion and achieve a 5-year CAGR of 17.1 in years 2019 to 2023. With customers' demands driving this era of digital transformation, the U.S. is responsible for 35% of this total spend. QTWO's customers include community and regional banks, enterprises, and Tier 1 banks, banks with $5 to $10 billion in assets. Given the variety of markets that this will benefit from the digital transformation tailwind, Q2 is in a good spot to capitalize on this macro trend. Broaden total addressable market share. The total addressable market in 2014 was an estimated $3.5 billion, while now the market size is estimated to be over $10 billion. By 2025, the addressable market is expected to be $12.03 billion, with a CAGR of 15%, with Q2 accounting for a market penetration rate of 4%. The company has already tapped into a few of the newest areas within the industry, such as banking as a service and cloud lending, which boosted registered users to 15.4 million, an 18% year-over-year growth. Q2 expects to see double-digit year-over-year growth in the following years. Historically, the company has worked to meet the market demands, and moving forward will continue to do so to preserve a runway of growth for the company. Expanding margins. Since going public, Q2 has seen impressive top-line growth in a highly consolidated space. The company in the past 5 years has grown gross margins from 41 to 49%. This margin acceleration has much to do with being able to tap into new digital banking markets such as digital lending and banking as a service. Margins for this industry are rapidly expanding as banks are consolidating and downsizing. The estimated industry average gross and EBITDA margins are 60 to 65% and 25 to 30% respectively. While many of these companies that consist of the industry average are in the mid-cap space offering more than just digital banking, Q2 has a competitive advantage to grow into that tier and capitalize on industry margin expansion. Now moving on to my valuation. In order to reach an intrinsic value for Q2, a 10-year DCF model was constructed using a terminal growth rate of 2% and a WACC of 8.17%. An intrinsic value of $120.12 was reached. A sensitivity analysis of plus or minus 25 bips on the terminal growth rate and WACC ranged from $95.92 to $142.19. Additionally, a price to sales multiple valuation was calculated, resulting in a multiple of 15.45 times and an intrinsic value of $103.02. Finally, an EV to sales multiple was evaluated using a blended average of 21.17 times, resulting in an intrinsic value of $141.10. By weighing these models 70, 15, 15, a price target of $120.70 was reached, resulting in a 24.62% upside. Q2 does not pay a dividend.
As far as risks for this firm, the first one that we considered was the reliance on banks and credit unions. Over 90% of total revenues are driven by banks and credit unions, most of which are regional and community banks. Banks and credit union closures reached 11,000 in 2016 and 10,400 in 2018. So if this trend is to continue or accelerate, Q2 is going to be vulnerable to material revenue losses. The next risk is cybersecurity. Providing products for digital banking implies the possession and storage of robust, sensitive information about clients and end users. In the event that a technology firm experiences a data breach, immense financial and reputational risks present the possibility of irreparable damage to the firm. And lastly, growth dependence on MD&A. Q2 has historically achieved most of its growth inorganically by means of mergers and acquisitions of smaller firms within the fintech industry. This strategy exposes the firm to risk of failure to execute growth should they fail to identify and close prospective acquisition deals in future periods. Q2 Holdings was founded by Standing Executive Chairman Robert H. Seal III in 2005. Matthew P. Flake serves as the current CEO and director of the firm and has held this position since 2008. Jennifer Knoll serves as the Chief Financial and Accounting Officer, and Adam Blue serves as the firm's Chief Technology Officer. Adam Blue has been involved in the tech industry for about 20 years and has held executive positions at 3 other firms prior to becoming the CTO of Q2 in 2010.